Right now, you probably think of your bank as a place, a building, a vault somewhere with your name attached to a pile of money that's just sitting there, waiting for you. You put money in, it stays in, and you take it out when you need it. That's the whole deal. It's simple, it's safe, and it's the one part of your financial life you never really think about. And that's exactly the point. Because the story you've been told about what a bank is doesn't just simplify how it works, it hides how it works. The truth is, your money isn't sitting in a vault. It's not sitting anywhere. The moment it lands in your account, it leaves. It gets lent out, moved around, turned into someone else's mortgage, someone else's car loan, someone else's business. What you have left isn't money. It's a promise that money will be there if you ask. And for that promise to hold, one thing has to stay true. You can't all ask at once. That's the game. And you were never told you were playing it. Now, I want to be clear about something before we go any further. This isn't a conspiracy. Nobody's hiding in a back room laughing at you. This is just how the system was built, out in the open, in plain sight, for hundreds of years. The reason it feels like a secret is that nothing in your everyday life ever forces you to notice it. Your card works. The ATM gives you cash. The number in the app goes up on payday. As long as the machine keeps humming, you never look under the hood. But the machine only works because of an assumption so quiet most people never hear it. And once you do hear it, you can't unhear it. So let's actually look under the hood, because there's far more going on with your money than the app is letting on. Let's start with the piece almost nobody gets right. When you deposit $1,000, the bank does not put your $1,000 in a drawer. It keeps a small slice on hand for people who want to withdraw, and it lends the rest out. This is called fractional reserve banking, and it's the foundation the entire modern financial world is built on. For most of the last century, banks in the United States were legally required to hold a certain fraction of deposits in reserve. 10% was the number people knew. Keep 10 cents of every dollar, lend out the other 90. That was the rule. Except here's the part that should stop you cold. That rule doesn't exist anymore. In March of 2020, the reserve requirement in the United States was cut to 0. Not lowered. 0. There is now no legal minimum forcing a bank to keep any specific fraction of your deposits on hand at all. The 10% everyone still pictures in their head describes a world that no longer exists. And I know how that sounds. It sounds like the kind of thing that would be front-page news. It wasn't. It was a technical footnote during a chaotic month, and it slipped past almost everyone. But hold that thought, because we'll come back to what a 0 looks like in practice. First, we need to understand what the lending actually does, because it does something most people would never believe if you told them cold. It creates money out of nothing. I mean that literally, not as a metaphor. Here's how it works. You deposit your $1,000. The bank lends 900 of it to someone buying a used car. That 900 gets deposited into the car seller's bank. Now that bank lends most of that out again, and again, and again. At every step, a new deposit appears, a new loan gets made, and the total amount of money in the system grows, even though no new physical cash was ever printed. Your original $1,000 can support many thousands of dollars of deposits scattered across the economy. The money wasn't moved, it was multiplied. And this isn't some fringe interpretation. The Bank of England, one of the oldest and most conservative central banks on earth, put out a paper explaining exactly this. The vast majority of money in a modern economy isn't created by the government printing it. It's created by ordinary commercial banks the moment they make a loan. Think about that for a second. Most of the money in existence, the money in your account right now, was conjured into being by a bank typing a number into a computer. That's not the shadow economy. That's the normal one. And if you want to feel just how lopsided this is, look at the actual numbers, because they're stranger than almost anyone realizes. Picture all the physical dollars in existence. Every bill in every wallet, every register, every safe, every stack of cash in the entire United States. Add it all up, and you get somewhere around $2 trillion of actual printed foldable money. Now picture the total pile of money people think they have. Everything in checking accounts, savings accounts, the numbers in all the apps. That figure is somewhere north of 20 trillion. So for every single physical dollar that actually exists, there are roughly $10 that are nothing more than a promise in a database. 10 to 1. The overwhelming majority of what we all call money has no physical form at all, and never did. It was spoken into existence by lending, and it lives entirely as claims. If everyone tried to turn their digital money into physical cash tomorrow, there wouldn't be remotely enough paper on Earth to hand it over. Not even close. And that's not a glitch waiting to be fixed. That's the system working exactly as designed. And if that sounds like something invented recently by people in glass towers, it isn't. This trick is old. Centuries old. Go back to the goldsmiths of the 1600s, the closest thing that era had to a bank. People had gold, and gold is heavy and dangerous to carry around, so they left it with the goldsmith for safekeeping and walked away with a paper receipt. That paper said, "The bearer of this note can come collect their gold any time." And here's what happened next. The thing that quietly changed the world. People stopped bothering to collect the gold. Why haul metal around when the paper spends just as well? The receipts started circulating as money in their own right. And the goldsmiths, watching their vaults stay mostly full day after day, noticed something they were never supposed to notice. Hardly anyone ever came for the actual gold. So they started writing receipts for gold that wasn't there, lending out paper claims on metal they didn't have, collecting interest on it, and betting, correctly, that not everyone would show up at once. That's it. That's the whole invention. That's the seed of every bank on the planet today. The technology got fancier. The core trick never changed. Write more claims than you can cover, and lean on the near certainty that they won't all be called in on the same afternoon. So now you can see the shape of the thing. The money in your account isn't a stack of bills with your name on it. It's an entry in a database, a claim. An IOU from the bank that says, "We owe you this, and you can have it whenever you want. And for as long as you don't actually want all of it at the same time as everyone else, that IOU behaves exactly like real money. You can spend it, send it, live your whole life on it, and never notice the difference. The promise and the thing become indistinguishable. Until the one day they don't. Because here's the crack running underneath the entire system. A bank, by design, can never give everyone their money back at the same time. It's impossible. The money isn't there. Because here's the crack running underneath the entire system. A bank, by design, can never give everyone their money back at the same time. It's impossible. The money isn't there. It's out in the world as other people's loans, tied up for years, sometimes decades. On any normal day, this is fine. Only a small fraction of customers want their cash on any given morning, and new deposits are always flowing in to cover them. The system breathes in and out, but it only works on one condition: confidence. As long as you believe the money is there, you don't rush to grab it, which means it doesn't need to be there. The belief is what keeps the belief true. But the second enough people stop believing, they all reach for the same door at the same time, and the whole thing turns inside out. Something that happened to your great-grandparents, something that can't happen now. We have rules now, we have insurance now, we're modern now. Let me tell you about March of 2023. There was a bank called Silicon Valley Bank. It wasn't a corner shop. It was the 16th largest bank in the United States, the beating heart of the tech industry, with hundreds of billions of dollars in assets. And to understand where that hole came from, you have to understand the second half of the trick, the part that sits right next to fractional reserves and does just as much quiet work. Banks don't just lend out your money. They lend it out for a long time while owing it to you for a short time. You can withdraw your deposit today, this instant, no notice required. But the mortgage the bank funded with it doesn't come back for 30 years. The bond it bought doesn't mature for a decade. This is called maturity transformation, and it's the engine of how banks make money. They borrow short from you cheaply, and they lend long to others for more. The gap is their profit. But it's also a landmine, because if the value of those long-term bets falls, the bank is suddenly sitting on assets worth less than the deposits it owes, and the only thing keeping that fact from mattering is that nobody's asked for their money back yet. That was Silicon Valley Bank. They had parked a mountain of deposits in long-dated bonds, and when interest rates shot up, those bonds cratered in value. The hole appeared, and the word got out. That word spread through group chats and private messages and social media, the way everything spreads now, instantly and everywhere at once. And its customers, who were mostly sophisticated companies, did the only rational thing. They tried to pull their money out. On a single day, customers tried to withdraw around $42 billion in one day. There is no bank on earth that can survive that, because the money, as we now understand, was never sitting in a vault. It was out in the world. Silicon Valley Bank didn't collapse because it was a scam. It collapsed because enough people, all at once, remembered the game they were playing and decided they didn't want to be the last one standing when the music stopped. The confidence broke. And the moment it broke, the money that everyone believed was there simply wasn't. So this is where you're probably thinking about the safety net. The one thing that's supposed to make all of this okay. Deposit insurance. In the United States, the FDIC insures your deposits up to $250,000, and that guarantee is real, and it matters, and it's a genuinely good thing. When Silicon Valley Bank failed, insured depositors were made whole. The system, in that case, held. But I want you to look at the safety net itself for a moment, because the same quiet trick is hiding inside it. The fund that backs all of this, the pool of money set aside to cover insured deposits across the entire country, does not hold anywhere near enough to cover all the deposits it insures. It's not supposed to. The target is to hold a little over 1 cent for every dollar of insured money in the system. Just over a penny on the dollar. And that's not a failure or a scandal. It works for the exact same reason the banks work. It assumes that not everyone fails at once, that the fires stay small enough and rare enough that a thin layer of water can put them out one at a time. The insurance is not a vault either. It's another promise, sitting on top of the first promise, and it rests on the very same assumption. Confidence. Don't all ask at once. And now you can see the full picture, and it's a little dizzying once it clicks. Your money is a promise from your bank. Your bank's ability to keep that promise depends on you not testing it. The insurance that protects the promise is itself a promise, backed by a fund that also depends on everyone not testing it at the same moment. It's promises resting on the single, load-bearing assumption that we will all keep believing together that everything is fine. The entire structure is held up by shared belief, not by gold, not by vaults, by the collective agreement to not look down. Now, I don't say any of this to scare you into stuffing cash under your mattress. That would be its own kind of mistake, and honestly a worse one for almost everyone. Cash under a mattress earns nothing, loses value to inflation every single year, and can be stolen or lost in a way a bank deposit can't. The point of understanding the game isn't to panic. It's the opposite. It's to see the board clearly, so you're not the one caught off guard when the mood shifts. Because the people who get hurt in these moments are never the ones who understood the game. They're the ones who thought they were just holding cash in a safe place and never realized they were holding a promise the whole time. So what do you actually do with this? A few things. And they're quieter and less dramatic than the doom you might expect. You pay attention to where your money is sitting. You notice whether your bank is boring and well-run or reaching for risk to juice its returns. You keep large balances within insured limits or spread across institutions so that a single failure never becomes your failure. And most of all, you stop thinking of your bank as a vault and start thinking of it as what it actually is. A counterparty. Someone on the other side of a deal with you. Someone whose promises are usually good, but are still, at the end of the day, promises. That single shift in how you see it changes how you make decisions, quietly, for the rest of your life. And ask yourself the question almost nobody asks. When was the last time you actually looked at your bank? Not the balance, the bank itself. Do you know what it does with your deposits, how much risk it's taking, whether the people running it are cautious or greedy? Almost certainly not. You picked it because it was convenient, or because your parents used it, or because it had a nice app. You handed it your money and your trust, and then you stopped thinking about it entirely, which is exactly what the whole system is counting on you to do. Convenience is the anesthetic. It puts the question to sleep. And a sleeping question is one you never get to answer until the moment it answers itself. Because here's the thing everyone eventually has to reckon with. The reason none of this feels real is that the game has been running smoothly for so long that we've forgotten it's a game at all. The pipes work, the card swipes, the number goes up, and that smoothness convinces us there's something solid underneath, when what's actually underneath is all of us agreeing not to look. That agreement has held mostly for generations. It will probably hold tomorrow and the day after that. But smooth is not the same as solid. And every so often, in a group chat or a headline or a single frantic afternoon, enough people remember what they're standing on. They look down. And when they do, they find out the same thing depositors have found out over and over across every century this system has existed. The money was never in the vault. It was in the belief. And the belief is the only thing holding the floor up. You don't get to choose whether you're in this game. If you keep money anywhere but under your own roof, you're already playing it, and you have been your whole life. The only choice you actually get is whether you understand the rules or not. Whether you're the person who sees the board, or the person who finds out how it works on the worst possible day when everyone's already at the door. And if you'd rather be the person who sees it coming, who understands the machine instead of just trusting it, then this is exactly the kind of thing I make this channel to show you. The parts of the system that are hiding in plain sight, right where nobody thinks to look. Hit subscribe, because the game doesn't stop just because you weren't told the rules. It just keeps playing, and the only real question left is whether you'll be watching the board, or whether you'll be the last one to realize you were ever on it.